When it comes to building a portfolio, I think that it's incredibly important before you build a portfolio is to really get your personal finances in good shape. I am personally a hyper conservative personal finance person. I have zero debt. I have 6+ months of cash in the bank at all times. And I have multiple sources of income in my life and a high savings rate. So from a personal finance perspective, I've done everything I can to make my personal finances bulletproof.
Welcome to Multiple Perspectives. I'm David Lofgren. I've been thinking a lot about how investing isn't just about spreadsheets and stock tickers. It's about psychology, right? Like you can have all the charts, the ratios, the models in the world, but if you can't manage your emotions when the market goes haywire, you'll end up sabotaging yourself. The markets aren't just numbers. They're reflections of human behavior, of fear, greed, and impatience. The tricky part is that most of us don't get taught how to handle those emotions in the context of investing. Business school can teach you discounted cash flows, but it doesn't prepare you for waking up to a 30% drop in your portfolio. That's why this conversation with Brian Feroldi was so compelling for me. Brian's a seasoned investor and educator who's made it his mission to help people understand that the mindset behind investing is often more important than the mechanics. He started his journey as a day trader, sort of chasing quick wins, which, spoiler alert, didn't go very well. But instead of giving up, he treated those early losses sort of as a tuition of sorts. What struck me is that instead of retreating or doubling down recklessly, Brian persisted. He shifted from chasing quick profits to building long-term conviction, and that became the foundation of his success. One of the big questions we explore is how you actually build conviction. Like what gives you the courage to buy Netflix, let's say, when it's 80% down, or, Chipotle after the E. coli crisis. For Brian, the answer is relatively simple, but it's not easy. You have to do the homework. You understand a company so thoroughly that when everyone else is panicking, you know why you're staying the course. That's contrarian investing in its truest form. Acting opposite the crowd, but only because you've done enough research to trust your thesis. And it goes deeper. Brian emphasizes the role of personal finance foundations in creating psychological safety. Like you can't take bold investment positions if you're swimming in debt or worried about the next month's rent. Having zero debt, 6 months of emergency savings, and a sensible retirement plan in index funds, those basics free Brian up to think clearly about active investing. And that reframes risk-taking in such a powerful way. I feel like, if you've built the stability in your personal finances, you can actually afford to be more daring in your portfolio. It's like building a safety net before you walk the tightrope. We also got into how modern investors can use AI tools to sharpen their analysis. Brian is clear. AI can help you parse the data or digest annual reports, but it can't replace your judgment. If you rely on it blindly, you risk falling into some of the same traps of shallow thinking. AI is a tool, not a substitute. Continuous learning also came up a lot, using podcasts, YouTube, blogs, but with the caveat that discernment is critical. Brian stresses going back to the source, like the company filings, and using modern tools as an enhancer rather than a crutch. That feels so relevant today. We're living in this age of information abundance. Everything is right at our fingertips because we have access to the internet, we have access to the AI tools. But the real challenge is developing the discipline to filter and focus. Finally, you'll hear how Brian balances his portfolio. Today, he says he's in 70% individual stocks that he's researched deeply, with the rest in index funds and cash. It's a mix that reflects his philosophy. Long-term conviction in specific companies grounded by financial prudence. If you've ever wondered why mindset matters more than market analysis, well, this conversation will connect the dots. Let's dive in. Brian, welcome to Multiple Perspectives.
Thanks for having me, David.
You've written in the past that one of the biggest edges in investing isn't necessarily the information that you can gather, but the mindset that you can get yourself into when approaching investing. And before we get into, frameworks or valuation models or anything, I'd love to start with some of your story. And I'm wondering if you can sort of take us back to your early days as an investor and describe what your mindset was, where you were, how you were approaching investing early on, and then maybe, how you started to rethink those things eventually.
So I bought my first stock in 2004. And at the time, I had effectively zero financial education. And I say that as someone that graduated with a degree in business from the University of Connecticut, which is a fine school. But in my opinion, I did not learn anything in that program about investing or personal finance or taxes or how companies compound. You learned management and accounting, all that kind of stuff, but it was never related to the real world. So I thought that quote unquote investing was buying something for $1 and then selling it for $1.08 later that same day or later that week. That's what I thought the stock market was. Now, thankfully, at the time, I was voraciously reading books about investing. I read Robert Kiyosaki's books, Rich Dad Poor Dad. I read Peter Lynch's books. I read personal finance books like The Millionaire Next Door. I read the Motley Fool's books. So while I had no clue what I was doing, when I bought my first stock, slowly over time, my mindset was developing more towards understanding what the markets were and how they worked. But when I first started, my mindset was completely, how can I make money as quickly as possible by effectively day trading? And as you're going to guess, that went very poorly. Everything that I bought my first year effectively went down and I sold it for a loss.
Fascinating. I don't think you're alone in that experience. Can you just talk about in those early days when you're doing that type of investing, were you aware that what you were doing was just kind of gambling, or did you feel like if I just do this enough, I'll figure it out? I'll start to see the patterns, the sort of beautiful mind numbers will start painting in front of my eyes as I'm looking at the ticker and be able to figure out where the value is or where the sort of potential for gain is, or did you know you were just sort of throwing spaghetti at the wall?
Well, at the beginning, I knew that I was throwing spaghetti at the wall because I would pull up a stock on Yahoo Finance and I would click over to the estimates button and the financial statements button and the profile button, and I would be like, I have no idea what any of this means, right? To me, this is I have no idea what this information is saying, let alone how to interpret it. All I could see was the share price, right? That's all I knew, was the share price and how much the share price was moving. Now, thankfully, even though I failed miserably with my first investing forays, I consider that to be the best tuition I've ever paid, right? It cost me a few $1,000s in trading losses, which I could write off on my tax bill, by the way. But the early lessons that I learned were so deeply seared into my brain that they started to pave the foundation for getting an actual financial education. The other thing I did that I didn't give up. I didn't let short-term setbacks derail me from trying to figure it out, because all the investing books that I read all said the same thing. The stock market was the most powerful wealth-building machine ever created. If you put money into it consistently over a couple of decades, you'll have a huge smile on your face and millions of dollars. So I stuck to the core principles of investing and I didn't give up, even though my early experiences were quite negative.
And that's what brings you here today, right? I'm wondering if there's a moment in those early days, or maybe sort of along the line, where all of a sudden you thought, okay, it's time for me to change my approach. Was there a passage in a book, a person that you interacted with, sort of a loss that you realized when you thought, okay, it's time for me to actually sort of hit pause, take a step back, reassess?
Yeah. So one of my more memorable failures early on is I bought stock in U.S. Airways. Do you remember U.S. Airways? They were
Okay, sure,
they,
yeah.
they were an airline.
Yeah.
I'd flown on US Airways before, and their stock was trading for like 80 cents a share or something like that. And I was like, okay, it's in my target range. So it's like $1 a share, right? And it's a company I've heard of. So I bought the stock and I was like, this is going to work out well. It went down to like 30 cents per share. And I think I sold it. With the benefit of hindsight, I actually went back and looked at the trade. It turns out US Airways declared bankruptcy and I bought it after they declared bankruptcy. So looking at that, and that was like, I don't know, the fifth or sixth time that I'd bought a stock and lost money on it. And my mindset switched to this is not working. So I thought about doing the exact opposite strategy. And I thought the exact opposite strategy is I'm going for dividends. And not just any dividends, I'm going for the highest yielding stocks that I can get. And I found stocks that had 20% dividend yields. And I had no concept of what a payout ratio is or how to check if the dividend is sustainable. I just figured it was like the interest rate on a bank account. And if it says on the screen 20% dividend yield, that's what I get as an investor. As you can imagine, companies that have 20% dividend yields, they're about to cut their dividend. Their dividend is about to disappear. That is like distressed assets. So yes, I shifted my mindset and that strategy failed miserably, too. And it was only after reading books from The Motley Fool and learning about Warren Buffett. And I was like, these guys are making money on Coca-Cola and Amazon and Apple and Netflix, like companies that not only had I heard of, I was a consumer of. And slowly that started to shift my mindset. The biggest barrier I had to get through was that those stocks were trading for like $40 a share, $80 a share, $200 a share. And I was like, how can I make money on a stock that's that quote unquote high dollar price when I just have a few hundred or a few $1,000s to invest in? But it just shows you that I was completely ignorant of what the markets were and how they work. But slowly over time, after you touch the hot stove enough times, you get in line with the strategies that work.
Yeah. Okay, so we've tried penny stock investing. That's not working. We've tried guessing at what dividends means. That's not working. What's the next phase? Like, how do you actually take the step into what you see as like your first sort of like wise investment?
When I first made an intelligent stock purchase where I actually understood the business, I bought Google in like February of 2009. Near the bottom of the great crash of 2008, and I was a fan of Google. I knew the business as a consumer. I could see the financial statements. I could understand strategy. I understood competitive advantage. I knew it was founder led, and I started to buy Google's stock. I don't know what the split adjusted price is, but I believe I'm up 20x on that investment, if not more, because they actually split into two different companies, two different tickers down the road. But I still hold those shares today, 16 years later. So Google is my longest held stock. And I would say that that's when I really started to understand the benefits of investing in real businesses with real earnings and cash flow and long-term growth potential and wide moats and durable competitive advantage run by able management teams. So, and then, I made a bazillion mistakes even after that point, but that was at least the first time that I started to buy good businesses and hold them for long periods of time.
Yeah, sure. So, one of the things that I appreciate about your work is that a lot of times you're talking about not just like tactics, not just sort of here's, what I look for when I'm analyzing a company, but a lot of what you speak with investors about and write about is sort of how you manage your own thinking. And it sounds like from your story that you've had a lot of opportunities to sort of think about your own thinking. Take a look at what was the pitfall that I fell into there. What was the sort of, false concept that my mind went on before I made this mistake. And I'm wondering if you can just sort of talk about what some of the most common psychological traps are that you see investors fall into. Particularly those who already have had a little bit of experience, the traps that maybe aren't quite as obvious?
I've come to learn the hard way that effectively, unless you are a psychopath, you were born a horrible investor. Like, it is natural. If you have natural human emotions, you are psychologically programmed at birth to be bad at investing. And what I mean by that is everything that feels good emotionally is usually the wrong thing to do from an investing perspective. The most comfortable time to jump into a stock or to buy an investment is after you've seen massive appreciation, when it's in the news, when people talk to have made money on that thing, when it's a well-known, well-publicized idea. The reason that that's a bad idea is because it's often trading at a very high valuation after the stock has appreciated. Conversely, the best investments that you can make are things that you almost like disgust you to look at. Like, it's after a stock, a good company has fallen 50%, or during the teeth of a bear market when people are around you are losing their job and there's just economic chaos happening. That takes real gusto and training to effectively do the thing that your body is screaming at you. Don't do this. It's uncomfortable. So the only way that you can do that, again, if you're not a psychopath and you're not born with those innate characteristics, is to study what the great investors before you say, think, and do. It's been said that the best time to buy is when there's blood on the street, when people are losing their minds and they're so emotionally distraught, and that they're willing to sell great assets at bargain bin prices. And so much of investing is not analysis. It's controlling your emotions. This is what Warren Buffett says. He said, what's the key to your success? It's really longevity and control of my emotions. Those are easy things to say. It's really easy to say, I'll be greedy when everyone else is fearful. It's entirely different thing to actually act greedily when everybody else that you interact with is feeling fearful. So if you want to develop an edge as an investor, the edges of investing are in psychology. They're not in analysis.
Interesting. Is there a time in your investing career that you sort of realized, like, oh, I'm doing it now? Like here I am. I should be terrified. I should be disgusted. I should be like, my emotions should be driving this analysis, or there would be. But for the first time, I'm sort of like seeing clearly that this is my moment. This is, I have the right information, or I have the right I can see all of the dominoes lined up or whatever. And like, now's my time to strike.
Yeah, there's been numerous instances when I've proven that to myself over the last 20 years. The first one I mentioned previously, which was when I was buying Google in February of 2009. Google's stock was down. I'll make up the numbers, but they're approximately correct. Google's stock was like $500 per share, and I started buying it at $200 per share. So it was down 60-ish% from its all-time high. That's when everybody was puking up stocks. Nobody wanted anything to do with the stock market in February of 2009, which made it a great time to buy. Now, if you zoom out and look at what the market has done from 2009 until today, all you'll see is like a line that looks like it's just gone straight up. But if you're an individual stock investor like I am, there have been numerous examples during that bull market when individual stocks that I have held or bought into were down 80% plus from their recent highs. One that comes to mind is Netflix. Do you remember in 2012 or 2013 when Netflix tried to launch Quickster?
No.
Okay, so Netflix was DVD by mail. That's how they started. And then they offered their DVD by mail subscribers free access to their streaming. It was like a perk. In 2013, they tried to split their business in two. They said, we're going to have a streaming and we're going to have a DVD. And they renamed the DVD thing Quickster. Wall Street hated it. They actually lost subscribers. There were screams on social media about Netflix, which was charging for both things differently, is raising prices 60%. The stock fell, peak to trough, 80+%. 80+% because of this move. I was buying into that 80% decline, even though it was the most hated stock.
Not a single good headline.
Now they reversed course. And then they came up with a more strategic plan for raising prices, and they did end up splitting the business. And now, of course, the DVD by mail doesn't exist anymore. They got rid of that 2 or 3 years ago. But that's one example of one company that I held during a massive 80% decline. Do you remember 2015, the Chipotle E. coli scare? You remember that one? Peak to trough, 75% decline in Chipotle's stock. I mean, if you were eating Chipotle, people would look at you funny, right? They'd be like, that's toxic material. Does anybody say anything about that anymore? But I was buying when Chipotle's stock was in free fall because of this E. coli scare. So there have been numerous instances, even during this bull market, when I've proven to myself that, yes, I don't mind buying when the rest of the world is puking up a stock that I happen to like. And every time that I've done that, well, not every time, when I've done that, oftentimes it's worked out extremely well in the long term.
Okay, so if I was a lay investor and, didn't have a ton of information or a ton of experience investing, I might be listening to this conversation and going, okay, what Brian's saying is wait until the stock price is falling, then invest. Is that the case? Is that should we just be trying to catch a falling knife every time we see one? What is the thing that allows you to go, okay, Chipotle, E. coli scare, this looks pretty bad. All of the headlines are bad. But I have confidence that this isn't the beginning of the end for this company. I have confidence that this is going to be a moment when Wall Street is trying to run away, and I'm going to be wise enough, hopefully, to recognize that there is a future potential in the value of this.
You framed that really importantly. If you were a layperson, if you were a beginner investor, you should not be buying stocks that are down substantially just because they are down. That is a recipe for disaster. Wall Street is usually correct. When Wall Street is bidding down a stock price, it's usually because the core business is fundamentally flawed in some way. For you to go in and buy a stock that is down big, you have to understand why it's down big and disagree with the long-term potential of the company. When I was buying Chipotle, it wasn't because there weren't food crisis issues. There were. It wasn't because same-store sales were declining. They were. My thought was, this won't matter in 18 months. I'm not holding the stock to flip it tomorrow. I think that 18 months from now, 5 years from now, there'll be more Chipotles. Everyone will have forgotten about this crisis, and the food is so damn good and the economics are so compelling that the stock price will be up. Let me give you an example. Right now, today, United Health Group, their stock is down like 60% from its all-time high. There's investigations into the business, and the stock is trading at its cheapest valuation in like 20 years. Is right now, today, a good time to buy United Health Group? The answer there for me is I don't know. I don't know United Health Group's business well enough to assess if Wall Street is correct or if in a few years' time, the stock will return to its all-time highs. I suspect that buying United Health Group today, very smart move in 5 years, but I haven't done the analysis and I don't understand the problems well enough to be able to invest my own capital with conviction. So there's an opportunity for United Health Group investors right now, but should a beginner investor dive in to buying United Health Group? Not unless that beginner investor fully understands how to analyze an insurance company, which is a very complicated thing to do, and have a different view than the market. So if you are a beginner investor, I don't recommend individual stock for your portfolio. If you're a beginner, I recommend index funds. Index funds are the right choice for 99% of people. It's only the 1% of people who have the interest in learning how to invest in individual stocks that should buy individual stocks. The problem is, in my experience, 99% of people do not have the interest in learning how to invest. They're absolutely smart enough. It's just that, are they willing to do the work necessary to make good decisions?
Okay, so it sounds like there are sort of two paths that we should explore here. One is the psychology of being an investor and trying to understand how to maybe sort of increase our metacognition. Can we say that? My Psych 101 class is coming back all of a sudden. Understand our theory of our own mind and see if we can subvert some of those instincts that we have when something feels good or feels bad. The other path it seems like we need to go down is trying to understand if someone does feel like they're interested in this type of investing, what you, Brian, would say are the first steps that you can take to try and start to build a thesis, to build an opinion that you feel like you can stand on, that you feel like you can literally put your money behind. So let's start first with psychology. Is there a practice? Is there a meditation mantra? I mean, what are the first steps that you suggest people look into if they think, I do want to be an active investor. I do really want to sort of participate in this in an active way. How do we overcome our own sort of heuristic biases?
So one of the reasons that every financial advisor suggests dollar cost averaging into index funds is because it solves both problems that you laid out. It takes psychology completely out of the equation. You're automatically buying on a fixed schedule. You don't have to think about it, right? And you're putting money in index funds. So you don't have to do any individual stock analysis. That's why the default advice is so solid for so many people. But let's assume you're in that 1% that is interested in the topic and wants to learn. Everybody has their own unique investing personality. Some people are natural gamblers. Some people avoid risk at all costs. So Aswat Damodaran, who's the dean of valuation, he has this fantastic quote. He says, the most important investor to study thoroughly is yourself. You need to understand how you acted during past market declines. Analyze your own personal behavior. What were your emotions when the market was declining? Were you scared? Did you have the urge to sell, or were you filled with glee and you were seeking out buying? If you were in the urge to sell category, congratulations, you know more about yourself. The next time the market declines, you're probably going to have the urge to sell. So don't bother being an active investor. Set up systems to prevent yourself from doing the wrong thing at the wrong time. That should be your focus. If you're the type of investor that got excited by market declines, the chances are good the next time the market declines, you will also be excited. And the way that I got over my psychological fear of investing in stocks that were falling is I studied market history. Once you study market history, you learn that nothing is new under the sun, right? There are cycles that humans as a group, investors as a group, go through, where there's periods of euphoria followed by periods of despair, and they return to the baseline. The cycle is predictable. The timing is not. That's what makes it so challenging. And then second, the only way to invest actively into individual stocks is to know those companies so well that you can have a different opinion than Wall Street on occasion, and you've done the work to have the conviction in your research. You can't just say, I like Google, I have an iPhone, therefore I like Apple. You have to be willing to look at the company's financials, the business model, the competitive position, and have a way to say, this is why I'm buying this stock. This is why the valuation makes sense. These are the risks that I'm assuming. Here's why Wall Street is incorrect about those risks. Unless you can form a full opinion about a stock, just index. Don't bother with any of the complexities.
Do you find that as you've gone through this process of sort of forming an opinion about a company, that you've been able to improve or reflect on that process itself as well, to go, okay, I had a thesis, I invested, it didn't turn out the way I thought it would. What went wrong? Like, is this like part of the plan that you have to constantly be reevaluating your approach?
Yes, this is. I mean, that's basic learning, right? You have a thesis, you put capital behind it, your thesis is proven wrong. Well, congratulations, you just spent your money on a lesson instead of making money from it. Yeah. So the good investors analyze their decisions, their past decisions, and look for Was I right? Was I right because of luck, or was I right because of analysis? Was I wrong? Was I wrong because of bad luck, or was my analysis wrong? Let me give you an example. About 5 years ago, I started to buy Grubhub. Grubhub is a publicly traded company. My thesis at the time was Grubhub was the largest delivery app in the United States. And my thesis was, since they have the most restaurants and since they have the most users, they're naturally going to form a monopoly in delivery because of network effects. Right? The buyers want to go to the place with the most restaurants. Restaurants want to go to the place with the most buyers. That thesis was proven wrong.
Yeah, we can all see where this is going. Yeah.
A little company called DoorDash came in and blew Grubhub out of the water. Just blew Grubhub out of the water. So that means that my initial analysis of Grubhub, that they had a competitive advantage in the market, was false, right? So I lost money on Grubhub, and I learned the nuance of network effects. And the thing that I learned is network effects at that level are very strong locally. So Grubhub might have had network effects in New York City or Boston or Tallahassee, Florida, but they didn't have network effects around the United States. So I learned, okay, after doing some analysis, how was my thesis wrong? Oh, I learned a more nuanced view of network effects. And to be clear, what Grubhub did was, what DoorDash did was very impressive. They came into a market that was, I thought, already won, and they beat out the incumbent. That's extremely impressive. They just outcompeted and out executed. So that was an example of I had a thesis, my thesis was wrong. Therefore, the next time I analyze a company with network effects, check for, are these real network effects or fake network effects?
Right. Interesting. Fascinating. Okay. So now let's say, let's take the other path for a minute. If folks are listening to this and going, man, this guy really knows how to think about businesses, think about the growth of businesses. What are the first steps that investors should be taking to try and learn how to develop a theory,
Well, we are spoiled today, right? When I started investing, the only way to learn this stuff was by books. Right? You had to buy books by the great investors, and there are, a couple dozen books that were worth reading out there. Today, you can go on effectively any social platform of your choosing. You can go on YouTube, you can go on podcasts, you can go to blogs, you can go to Twitter. Heck, you can even go to TikTok. And if you follow the right people, you can actually learn how to read SEC filings, analyze financial statements, do competitive analysis, do risk analysis. You can learn all those things today on your favorite medium of choice. The caveat there is the onus is on you to follow and find the right people, and to avoid the charlatans. And there's tons of charlatans on every platform. But if you're an audio person, there are infinite ways to listen to podcasts nowadays or audiobooks and learn this stuff. If you are a video person, tons of great content on YouTube or how to do this. If you're willing to pay for courses, there are courses you can buy relatively cheaply that teach this kind of stuff in a more structured manner. But the core thing that I would encourage people to do that own individual stocks and actually have an interest in this is read the annual report. These are free. Companies are required by law to produce an annual report and make them freely available to prospective shareholders. So if you're interested in Amazon as a stock, great. Read the annual report. I guarantee you will learn a ton about Amazon that you didn't know. If you have a question about what does this mean? Well, we're even more spoiled today because you can just take a picture of it, upload it to ChatGPT and say, what does this mean? Explain it to me like I'm 5 years old, and it will do that. Or you can even upload a whole annual report and say, what risks am I taking on as a shareholder in Amazon? And it will actually give you information about that. So to be clear, AI is a wonderful research assistant, but it can't replace thinking, and it certainly can't replace conviction, which is the whole point of reading the 10K in the first place. Your job is to figure out, is this a good investment? And do I know in my bones why it's a good investment? And the reason that's important is I guarantee you, whatever stock you're researching, it's going to fall hard at some point in the next 5 to 10 years. And without conviction, You will have no clue whether that fall is deserved and if you should buy more, or you'll do the worst thing and panic sell. So I got off on a tangent there, but I hope I answered some of your questions.
Great. That's great. I wonder, some of the premise that we're working on here is, as you said, for the vast majority of investors, investing dollar cost averaging into index funds is what your financial advisor is going to suggest. And that's probably the best case if you don't actually want to take the time to develop a thesis, to study yourself, to understand the psychology of your own investing tendencies, and to try and learn from those experiences over and over and over again, that constant reflection and revision. I'm wondering if there is like a test that you feel like we could perform on ourselves to figure out, am I this 1%? Am I like, do I just kind of like gambling? Or do I, or am I actually the right person? Do I have the right mindset, the right approach to dive into this thing?
Yeah, the answer to that to me is, are you excited about spending your free time learning this stuff? That's what it did it for me. When I was learning this stuff 20 plus years ago, I was in sales at the time. So I was in my car for 30 hours a week. I spent every bit of that time listening to audiobooks about investing, trying to listen to investor conference calls, listening to podcasts, the very few that existed back then about investing. I was doing everything I possibly could. And when I got home, I would go online and read Yahoo Finance articles and Motley Fool articles and Morningstar articles and try and connect with other investors. So you did not have to try and convince me, hey, do your research on this investing. I was doing it in every bit of free time that I possibly could. That's a pretty strong sign that I was the right personality for investing in individual stocks. If the idea of that just bores you to tears, or if it feels like homework, if it's an onerous thing to do for you to dive into details on this stuff, that's a very clear sign that it's not for you, which is totally fine. Investing was my passion and my side hustle. So that to me is the test. Does it feel like homework or does it feel like fun? If it feels like fun, then to me you have a blessing to buy individual stocks.
I think it's Charles Bukowski that has a poem about, or an essay about, if you should be a writer. And he says something along the lines of, unless you wake up in the middle of the night in a cold sweat with no other cure for that than to start writing, do something else. I have a couple of follow-up questions because you piqued a couple of interests of mine there. But I at first I want to like take a step back and just ask you what your feelings are about building a portfolio broadly. As someone who's really invested in, no pun intended, really invested in sort of public markets, actively picking stocks, is that everything in your portfolio, or do you sort of have a theory of how you're constructing a broader portfolio? Do you have some way that you suggest people think about, especially if you're actively investing, sort of hedging some of that?
And first, let me say that my money is where my mouth is. About 70% of my personal net worth is in individual stocks. In addition to that, I do have money in index funds, and that is my retirement accounts. Beyond that, I pretty much have cash in my house. So my capital is in the stock market. That is where my capital is. When it comes to building a portfolio, I think that it's incredibly important before you build a portfolio is to really get your personal finances in good shape. I am personally a hyper conservative personal finance person. I have zero debt. I have 6+ months of cash in the bank at all times, and I have multiple sources of income in my life and a high savings rate. So from a personal finance perspective, I've done everything I can to make my personal finances bulletproof. That gives me the psychological safety that I need to be willing to essentially be 100% stocks with my investments, because I know that if 2008 hits again or something worse hits again, that if my portfolio declines 60%, wow, would that suck. It would hurt so bad emotionally, but it would in no way change anything about my actual day-to-day life. I wouldn't be missing a mortgage payment because of it. I wouldn't be missing a car payment because of it. Like our portfolio could fall 60% and my wife could lose her job. And from a personal perspective, we would still be okay. So that gives me the psychological safety that I need to invest with gusto. So I think taking care of your personal finances first is what everyone needs to do before they think about building a portfolio. I basically, my portfolio is a hand-picked ETF, exchange traded fund, if you will. I have about 30 companies in there. Many of which I've held for 5, 10, or even 16 years in the case of Google. And I add companies to the portfolio. And my general philosophy is buy great companies, hold them for long periods of time. Easy to say, really hard to actually do and execute. But when it comes to building a portfolio and figuring out how much do I allocate to this stock or that stock, I let the market do the heavy lifting for me. I get the stocks into my portfolio, and then my biggest holdings simply become my biggest winners. So they earn a higher spot in my portfolio by going up. And the companies that I buy that are losers, they become irrelevant tax write-offs for me because their allocation effectively rounds to zero for me. So my portfolio today, my top 10 holdings are all companies that I bought at least 5 years ago, most of them 10 plus years ago, that have been long-term tremendous winners. And that style of investing fits my personality very well.
Interesting. Fascinating. And it strikes me that when you say, I have index funds, that's my retirement account, there might be some folks who are listening that are going, okay, I'm going to try and do some stock picking with my retirement account. That's like, for many people, their entire personal finance sort of outlook is based on a fairly small allocation that they might do something risky with. You're saying, no. That stuff's all taken care of. It's all separate from this sort of the self-directed investing.
That is what I do. From a tax perspective, my philosophy is actually flipped. So if you're a tax advisor listening to what I just said, you're probably screaming at the mic at the car right now saying that's exactly the wrong thing to do from a tax perspective. I'm fully aware of that. From a tax perspective, you actually want your active things to be in your Roth and your traditional IRA to get shielding from taxes, and you want your taxable to be in index funds. When I contributed to my 401k at the time for the company I worked for, you're very limited with your choices, right? You can only invest in funds effectively. And from a sheer simplicity perspective, I've chosen at a category level, all retirement funds are index funds. Set it and forget it. Don't ever think about it. And all active funds are into a taxable brokerage account. That is not optimal from a tax perspective, but it is optimal from a life simplicity perspective. And that's what I choose to focus on.
Lifestyle investing. I wonder, we're almost out of time here, so I want to wrap it up soon, but I wonder if you can talk about how the advent of AI has changed your approach. Since you've been doing this for a long time, I imagine you had a lot of systems in place when, ChatGPT hit the scene. Is that meaningfully changing your approach or your research techniques? Or are you just kind of going, listen, I already know that what I'm doing is succeeding, so I'm not going to incorporate that too much?
I've only recently, in the last couple of months, started to take the AI portion seriously, and really asking myself, how can I build this into my process? And I'm doing that not just with my investments, with basically everything in my life. But I think AI is a wonderful research. You have to think of it as a junior analyst that you employ for free. So I would never buy or sell something just based on what ChatGPT said about it. But I have developed a series of prompts that I use to say, hey, here's a company. Analyze its moat for me, its competitive advantage. And tell me, do you think it has a moat? Link to specific clickable resources to verify your opinion, and also search the recent news to see, are there any threats to the company's moat that I should be aware of? It does that brilliantly. And the analysis that I can read and says, this is effectively the conclusion that I would have drawn on my own. I'm looking for ways for AI to help me with the tracking of a company's earnings, because that is a fairly laborious process. So I'm trying to find ways for it to scan through earnings reports and then maybe email me a quick summary with just a thesis on track or thesis in question type of analysis. That would be useful to me as an investor. So AI will augment my process. It won't replace my process, but we're just at the beginning of like what AI is capable of. So I'm very confident that as I learn more about AI and get better at using it, I'll find more ways to use it effectively in my investings.
Absolutely, yeah. Yeah, that totally makes sense. And is it also changing the way that you're looking at companies? Are you starting to think about, okay, how will the advent of AI and the evolution of this stuff impact the businesses that I'm investing into?
Absolutely. I think it's going to dramatically change competitive advantage. If small 1 and 5 person teams can compete effectively against bigger digital companies like Salesforce.com and Adobe, it could have long-lasting impacts for competitive advantage in the market. And suddenly, a key question to ask yourself before analyzing any company is AI a threat to this business? Or is it a opportunity for this business? And it might be both at the same time. A smarter investor than me was told about everything that's happening with AI, and he was asked what he was going to do, and he said, "I'm going to buy railroad stocks." And effectively, his answer was, "I'm going to buy things that are the most AI resistant that I can think of." That's not a bad strategy, right? Like, where is the AI going to go in the future? I don't know. How is that going to impact Google, and how is that going to impact Amazon? I don't know, but the odds are pretty good. 30 years from now, railroads won't look too differently than they do today.
Fascinating. Brian, thank you so much for your time today. Really appreciate it.
Thank you for having me. It was a wonderful conversation.
All right. That was my conversation with Brian Feroldi. What stood out most to me is how much Brian's story shows you that early mistakes don't define you. They shape you. He didn't lose those initial losses in day trading and let them push him out of investing. He used them as lessons. That persistence, combined with his shift towards a long-term mindset, feels like a powerful model for anyone trying to navigate markets today. His point about psychological safety is critical. It's not glamorous advice. Pay off your debt, build an emergency fund. We've all heard those things before, but it is the foundation that allows you to think rationally when the markets are inconsistent or when there's volatility. Without that stability in your planning and preparation, you're always just one paycheck away from panic-driven decisions. And once you have that foundation, you can act with courage when fear is everywhere else. I love those examples that he gives us of buying Netflix and Chipotle and Google during big downturns. It highlights how conviction comes from, not just trying to time the market, but a really deep understanding of the foundations of those businesses and potentially their longevity in the marketplace. The biggest takeaway for me, though, is this. Do your homework, know the fundamentals, and trust your thesis. Pair that with his advice that 99% of people should just stick with index funds. And you've got a clear framework for knowing where you fit. The balance that Brian describes, using index funds for retirement, keeping cash reserves, and then actively investing with a portion of your wealth, really shows that you don't have to pick one lane. You can be both conservative and bold, but only if you structure it thoughtfully. And I found his perspective on AI refreshing too. That it's not about replacing analysis, but about enhancing it. The human judgment piece, the psychology, remains irreplaceable. So if I had to sum it up, I would say that investing isn't about having the best model. It's not about, being able to sort of predict perfectly. It's about having the right mindset. Build your personal finance foundation, commit to continuous learning, and don't underestimate the role of discipline when the market turns against you. If you found value in Brian's perspective, share this episode with someone who's trying to get more serious about their investing journey. These are the kinds of conversations that can help people avoid years of costly mistakes. Thanks for joining me on Multiple Perspectives. I'm David Lofgren, and I'll catch you next time.